right, everyone. Hope you can all hear me all right. I think we're just after 11 here, so we're going to go ahead and get started.
Here, David, let's give it a couple minutes to make sure everybody gets in.
Okay.
We still got.
And this is going to be recorded and available later if they want it, right?
Yeah, we're going to have this recorded, and I'll send out a link to everybody that registered once this is over later on this afternoon. Perfect. Hi, I'm Josh. I'm the compliance guy here at Commstock. Matthew is leading a tour in Brazil currently, so he will not be with us today. So I'm taking over for him. I got the easy job. Just got to introduce our buddy David Shively. He's one of our brokers here at Commstock. He's based out of northern Missouri or northeast Missouri. Looks like he stepped away for a second. But looks
right
like
back.
Okay, we got a couple people still filtering in. If you guys have any questions, feel free to use the Q&A box on the bottom you can click into, or you can also raise your hand and I'll try to get to you. I'll be monitoring the chat and the Q&A on for questions. So I think looks like everybody that is going to get in at the beginning has gotten in. So David, I'll turn it over to you.
All right. Well, like I said, hopefully everybody can hear me good. We'll go ahead and get started. So this is just kind of our market outlook. I'm going to focus mostly on the grains, although I will talk a little bit about the livestock at the end. What we're kind of looking at here for 2023. This is just our disclaimer. Futures trading involves risk. I'll leave this up here a second so you can read at your own speed. This is just kind of a boilerplate to let you know that there is some risk involved. And these are, trade advice that we give. Nothing's guaranteed. All right, so I'm going to start off by talking about, what are the good things out there that's helping us. We'll get into some of the negatives later and what that means for the market. So just start out with kind of the positive things. For both corn and beans right now, got relatively tight supplies. Of course, we'll get into each of these points a little more later on. The one caveat to that is that the really tight supplies we're seeing in some areas, that's more of a regional problem than a widespread nationwide problem. We've got fairly good domestic demand. That's going to help us, and we're seeing that reflected in the basis. And we're coming into seasonality, typically helps us out this time of year. So just going to go through the WSDA numbers on corn from last week. The numbers in black are from January report. The numbers in red are from a year ago. So our beginning stocks on corn were up just a little bit from this time, or from a year ago. Our production's down a fair amount. You can see 13.7 versus 15. Dropped yield 3.5 bushels. The more troubling number on this screen is the exports being down. Not only are we down in absolute bushels by 500 million, but more importantly, we're down by 2.4 almost percentage points as a percentage of production. So despite producing 1.3 billion bushels less corn, we're only selling 14% instead of 16.4. We'll get into why those export numbers are a little more troubling in a bit, but that's the ugly number on the screen here. Now, even with that, we've got some lower ending stocks by a little bit, a little higher average farm price. Now, this is a chart I like. So the red bar there shows you the stocks to use ratio, and the green line shows you the average farm price. And so you can see here right now, we've got a pretty tight stocks to use ratio, 8.93%. You can look at this chart and see that historically that is a very tight number. Not as tight as we saw back in 11, 12, 13, but we're right there. And you can also see, looking at this chart, that there's a pretty good relationship between a tight stocks to use ratio and a high farm price. And so, does a great deal of explaining why we've seen the prices we've seen the last year and a half. and also why that stocks use is helpful for us. And then this chart I also like, shows us the demand. This one is strictly for feed and residual. Feed is the 95% of that chart. But what we're seeing here, if you look at the red bar on the end, that's this is most recent versus previous years, and you can see we're dropping back off now. We're not historically tight numbers at all, but you can see it's basically a 4-year trend of dropping feed demand. We're dropping a 7.8% in demand for feed over last year. Down almost 8% in a year alone is a pretty significant drop. Part of that can be explained by just stock numbers. We're down 2% on hogs, according to the Deese Hogs and Pigs report. We're down 2.6% on cattle numbers. You keep dropping those numbers, so you're going to need less feed. But also coming into that is some of the pricing, some of the other alternatives out there, and even poultry numbers that are fighting some bird flu right now. So, that we talked about how there's decent domestic demand, but it's not outstanding. And this chart here does a good part of explaining why. Second one on corn demand of why it's a little bit less than stellar is ethanol usage. Now there's a couple other things in here, but this is mostly ethanol. It's only 1% drop over last year. That's a small change. That's a tweak. But cheap crude's a little cheaper than it was a year ago. A lot of the areas where we have the big ethanol plants are looking at pretty high basis right now, so that's making it a little tighter on the supply side for them to compete. We're well off the peak from 5-6 years ago there, but overall year to year it's not a bad number, but you would like to see it climb like we were from the last 30 years up until really the last 5. So we'll get back into some more problems on the corn by wanting to go through just the basic numbers on the beans for you here. So the January report for the beans had beginning stocks up a little bit from last year, production down a bit. That's mostly explained with the yield number, which dropped 2.2 bushel. Exports down, same story as the corn. We're down in absolute numbers on the exports, partly explained by lesser production. We're also down as a percentage of production. That's a more troubling number. And we're looking at very tight ending stocks again, down to 210 million bushel. And now that's how the USDA is coming up with a higher average farm price at $14.20. Now these are the same charts I showed you for the corn, for the beans. Our bean stock to use ratio is down to 4.82, tightest it's been for several years. Also why we've got the highest bean prices we've had since 13-14, and that's what we're seeing. This chart does an amazing job of explaining that price ratio, at least over the last 15-20 years. And okay, here's a chart I pulled up for bean demand. On corn, we talked about feed and ethanol. On beans, the big story here over the last several months has been soybean meal. The demand for meal has been outstanding, and it just stayed that way. Now, the last couple of days of trading, we did drop off the high. I think it was Thursday, we took out $500 on the March meal, which is just especially given where all the other alternatives are, that's some pretty expensive meal, and the fact that we're still selling it there, it's a pretty strong testament to the demand. Also makes it a little troubling that the soybean oil is so cheap and that meal to oil ratio is so out of whack. They're entirely dependent upon the meal to hold up the soy complex right now. So even though we've got some exceptionally strong crush margins, despite high bean prices, we're almost entirely dependent on one half of that crush spread, and the oil is not doing its part to hold up its end. Okay, and then I mentioned seasonality is just kind of a positive factor for both corn and beans right now. It's just time of year. You typically get a post-harvest or spring rally. We already saw some post-harvest rally, you could argue, but typically that continues into the spring, mostly because you're building in weather premium. and you're buying acreage for crop insurance. That corn versus bean, what you're going to plant where, and some of the other crops even come into that. We'll get into that a bit. Also, we're looking at South American weather really hard right now, particularly Brazil, also Argentina to a point. So on the South American weather, what are we looking at? Their early planting conditions were just outstanding. The crop went in the ground, very few problems. Most of Brazil is in pretty much perfect conditions for the most part. The southern extreme in Argentina have been trending dry. From what I've been hearing, they did get some rain over the weekend here, so I'm not sure if that's been enough to break them out of that dry pattern, but it probably helped. But if there's a time of year to be dry, it's when you're wrapping up planting, and so it's really hasn't hurt them too much yet. Now Argentina in particular, if they don't see a change soon, it's going to start costing them some bushels, but that the breadbasket of Brazil has had near perfect conditions. So all of South America really still has potential for an exceptional crop. And thing to remember there though is that February is their August. August is when we can burn up and lose a crop. It's kind of a way for them in February. Not all of Brazil or South America, because it's like comparing Minnesota season to Texas season. They're spread out. It's all a little different, but as a general rule of thumb, February is the month where they can burn up. So we kind of glanced across some things that look positive for us. Let's look at some things that are leaning a bit more negative. Biggest ones, exports have slowed down. It's a bigger story on corn than it is beans, but a little bit for both of them. COVID's ramping back up in China. That's slowing down a lot of their demand side and just a lot of the logistics side for them. And we're having problems with Mexico. If you heard about their wanting to ban GMO corn from us, and they're playing games is what it amounts to. They've got an antagonistic president that wants to get to us if he can. And so far he's managing to slow down the corn imports a fair amount. Some of the other things, the administration in Washington continues to not be overly helpful to what we're trying to do right now. We're sitting here, everybody thought they were going to raise the RFS minimums a couple months back, and they didn't. 10, 15 years ago, ethanol and biodiesel were the golden standard for renewable energy, and now they don't seem to count anymore. They're looked down upon, and so we keep hearing all this push for green energy, and our green industries are being left out in the cold there. Add into that, touched on earlier, cattle and hog numbers are dropping. The cattle in particular, that's a long-term trend, but it is continuing, and that every head you drop, there's that much less grain you need. So the corn exports number. The biggest figure you're going to look at on this one is that far right set of bars on this chart. The most recent one being for this year, the 22-23 there. You can see that we're dragging well behind where we were the last couple of years. And this is as of December 1st. It's most recent I'd found on this chart. But these are exports and commitments for this marketing year. And you can see that we're falling well behind where we should have been the last couple of years. And you can see that China's a big drop there. Mexico's been a drop. Japan's a drop. Even South Korea's a drop. Now, part of that is that the last 2 years we were front loading sales a bit more than normal. But you can go back to 18, 19 and see that we're still behind where we had been in the past. We're only, this chart only shows 4 months into the marketing year, so there's a lot of time left. But as we move deeper into the marketing year, that's when grain's going to start coming out of South America and cutting into our exports. So the front loading has been advantageous to us in terms of increasing absolute exports. Okay, the soybeans, I couldn't find that same nifty little chart, but so far through December, we're actually on track for the USDA's target. They're just below 2 billion bushels. Also, just 4 months in the year, In the past, not so much the last year or two, but in years before that, we tended to be pretty back heavy on the soybeans, where we kind of dragged throughout the year, and China came in at the end and made some huge purchases. Perhaps we'll see us move back into that pattern. But we do still have the COVID flaring up in China, and South America's crops can be coming online here in a few months. So that, those are things that are going to slow it down. Mentioned trouble with our trade partners, soybeans. Despite all the problems we had over the last 4 or 5 years, working out trade relations with China and all this antagonism. At the end of the day, China is still our soybean market. That has not changed. And when they have problems, our soybean exports are going to struggle. Same thing, the corn. China's a big portion of that market, but even the other markets like Mexico, we're having some problems. They don't want GMO corn. It's not really a real complaint. It's more just an excuse to enact some protectionist measures and stick it to the U.S. But until we get that sorted, it's going to be a problem. Okay, I mentioned government problems, particularly the green energy. They no longer lump ethanol and biodiesel into that. They're not raising the RFS minimums. We're not getting any help to increase that crush. One thing that might change there, starting January here, we've got a divided legislative branch. Should probably at least slow down any changes coming out of Washington, at least through the legislative branch. We can still see some executive changes, but I do expect that to slow down any changes over the next couple of years as compared to the last couple. Okay, I mentioned cattle numbers. This chart, I'm not entirely certain why they were missing a couple of years' data here and there, but I show this chart every year, and it just keeps continuing on down. Yeah, we're up off the rock bottom there back in 12 and everything burnt up and we liquidated. We managed to get up off that bottom, but you can see this is a 25-year trend of us dropping cattle numbers with one or two little bounces in there. Second or third year in a row of us dropping 2% or more. It's a long-term issue. Doesn't look like it's going to be turned around anytime soon. A combination of a lot of grassland getting torn up and farmed, and beef demand. We continue to see more and more shift towards white meats over beef, and that's going to continue to happen more than likely. So as cattle numbers are dropping, that is going to be long term. That much less corn we need at the feedlots. Yeah. Mention on hog numbers, dropped 2% from last year. That was a drop from the year before. But you can see this is a much more short-term problem. This has a lot less to do with, an institutional change, long-term trend in the cattle. Whereas in hogs, it's more, we had problems with COVID and liquidated some hogs when we couldn't move them. And then we had problems with some diseases and PRRS and all this. And so the numbers are down on hogs, but we haven't gotten into a long-term trend of liquidating hogs. This is more a, 2-3 year blip. At least we can hope it is. There have been some finishers that are having trouble filling up the barns, but here again, this should be more of a short-term problem. So kind of glanced over some positives and negatives, and don't worry, we're going to get into marketing here in a bit. The wild cards out there, the weather, we don't know what it's going to do. China, Russia, don't know how they're going to shake out. And the USDA can always throw a wrench into things, as they've shown us the last several years. So the one big thing to keep in mind on the weather, and I'm no meteorologist, but we've been experiencing La Nina conditions for the last, I think, about 2 years. Kind of the rule of thumb is it's a little bit better than average growing conditions here, a little bit worse than average in South America. From the meteorologists that I listen to and follow, they're tracking on that, different ocean tides and wind patterns and all, but basically they expect La Nina to fade out over the next few months and not just stop at a neutral level, but actually move into an El Nino. which you kind of flip those conditions. A little bit worse for the U.S., a little bit better for South America. They expect us to be there by mid to late summer. We're coming into this season with the northern and western corn belt already pretty dry. Yes, they've gotten some snow and moisture here the last month, but they were dry all last summer. We're dry coming into the winter. And a foot of snow does not equal a foot of rain. So they need a good wet recharge that they haven't gotten so far. We've also got that problem down in the wheat belt where the water's not quite as necessary in huge volumes, but they still got to have it. So those troubling conditions of the El Nino this summer may not have much of a reserve built up yet to get through that. Okay, China. One good news about China is that a year and a half, 2 years ago, we were really hearing them beating the drums of war against Taiwan. They basically took back Hong Kong and faced no real repercussions. It wasn't hard to see they were gearing up to try the same in Taiwan. Russia doing Ukraine was kind of a weather balloon for them. I think they were sitting there waiting to see how that went. It has not gone very well for Russia, and so that seems to have quieted China down. They've seen the international response and seem to have kind of backed down the hawks there and want to take a more peaceful long-term approach, at least for the time being. That keeps us right out of the meat grinder, and COVID flaring back up probably is going to keep them from wanting to do too much as well. In Russia, like I mentioned, things have not gone the best for them in the Ukraine. That said, I don't see them backing down anytime soon. They've lost a lot of ground the last few weeks, a good portion of what they had originally taken. The U.S. keeps throwing money in for Ukraine. The European Union is at least talking about throwing money and weapons in, although their follow through has been less than ideal. But the international support for Ukraine's been pretty substantial and been enough to stop Russia in its tracks. And, even some trade partners putting a price cap on Russian energy and things like this. It's all done a lot to slow down Russia. Ukraine's getting some grain out again, although Russia is too. So, as long as Ukraine's moving grain out, we're not going to have that benefit of, the world's third or fourth largest grain producer not being able to ship out grain like we've had the last year or so. Okay, USDA, big thing to look out for. There will be a Feb WASDE, but the big thing is the outlook for them. They do at the end of February. It's where they give their big spiels for the next year. We've seen a lot of volatility in the USDA reports month to month over the last 2 or 3 years. A lot of big corrections going backwards, bigger swings than what we've had in the past. Part of that is just more volatility in the markets as a whole that the USDA has had problems correcting for, but it's a trend that we've seen and doesn't seem to be changing. And as long as the USDA keeps injecting artificial volatility into our markets, it's going to be something we're going to have to watch and trade through to market our grain effectively. So what's this tell us for soybeans? Supplies are tight, even tighter than last year. Demand is decent domestically, but overall it's less than stellar. Our exports are struggling. We're not crushing more for biodiesel. So it's not terrible. It's not great. The volatility's here. It's going to stay here. Thing to look at, though, we are at profitable levels for old crop. We saw a big sell-off last week ahead of, really since the first of the year, prior to the USDA report last week there on Thursday. Got a couple days of trading up. It's traded either side of unchanged today. Depending on how far sold you are, you really should be looking to keep moving some beans. If you're 3/4 sold, you could probably tap the brakes. But if you're sitting here 10, 20, 30% sold, you should really be advancing some sales. Most places, and grain of salt, most are still looking at some pretty solid basis levels. And even if you're not, you can always do a contract and leave the basis open, or use paper, sell futures or buy some puts, things like that. A lot of different ways to go about it. The point is you should be advancing some sales, getting some beans moved here. We spent a lot on the inputs. Operating cost is coming up. Operating interest is going up, but we want to be making some sales here. Okay, so for marketing corn, this is a chart I like. Depending on where you guys are, it may not be very useful to you, but it tells an interesting story, particularly the right half of it. And this is basis deviation. So difference in the basis for the current, well, for last week, as opposed to the average for that week over the last 3 years. And you can see that everywhere on this chart is actually better than it has been the average of the last 3 years. Now, up in my area in Northeast Missouri, we're only 11 cents better. Whereas you get out to where they have a lot of problems, in Southwest Kansas and Oklahoma, the Western Oklahoma, you can see they're $1.23 better than they have been the last 3 years. That's an outstanding basis. That's telling you a story of great localized demand, and great chance to move grain. I know it's not that way everywhere, but I'd say by and large, throughout the Corn Belt, the basis is stronger than it has been the last few years. So what do we do with our old crop corn? Well, take advantage of that strong basis. As far as board price, we're not too far from $7. That should probably say 15 days ago instead of 10. The end of the year, things look pretty rosy to put a few more cents on, but some things changed there first week of January, set us back. We're not far from $7 board right now. Most places have a pretty strong positive basis. You're looking at $7.50 corn in most areas. Don't be afraid to move some corn and take advantage of this. And I think this year as a whole, you're going to want to have your sales loaded more into the winter and spring rather than through the mid to late summer. I think that's going to benefit you. What do we do on the new crop corn? Well, the last 2 to 3 years, it has not paid you to hedge. It just hasn't. We've gotten late year rallies. We've had depressed new crop prices throughout the spring and summer that didn't give you a good hedge opportunity. And then, the guys who didn't hedge got bailed out by a rally at harvest or later. That's been great these last couple of years, but long-term trends, that is not something you can expect to last forever. And this year is setting up differently. And so you need to be able to plan and hedge appropriately. Now, it closed Friday at 598.5 per new crop. Now, I know we just talked about almost 7 on old crop. It's hard to get excited about selling the dollar discount. Would be nice to see, 10, 25, 35 cents more on that. But if we do start getting into those numbers, 6, 625, 635, you guys really need to start protecting some of that production, whether sales, hedges, puts, something. Get something in place to protect that. I think this is going to be a year where the guys who market aggressively make out well. You're probably going to want to have a lot of it protected before we get into planting. The inputs, and your nitrogen's probably not as high as it was this time last year, but this fall you didn't really have an opportunity to get it bought cheap. It's actually been coming down, whereas fall 21 you had a chance to get it bought cheap before it all ran up and got crazy. Okay, soybeans. So this is those same basis charts I showed you on the corn for the beans. Here again, if you're in Iowa, Illinois, it's not as helpful, but it just tells the story on the basis. And here again, even where it's 22 cents here in Northeast Missouri versus 90 cents down there, Kansas and Northern Oklahoma, tells you that we've got a hole in the soybean supply. We've got outstanding localized demand for beans, and they're worth a lot more than they were, basis wise last year or in the last 3 years. So, guy needs to take advantage of that when he gets that opportunity. Most of that's coming from the crush demand for that $470, $480, $500 meal. So what do we do with the old crop beans? Continue to make your sales. Sell the rallies when we get them. We had a nice pop up Thursday, Friday last week. They tried to set it back in the overnight, but before I hopped off for this, we were trying to climb up a little more again on these beans. We'll be making sales into those types of rallies. I'm not saying you need to be 90% sold, but if you're 30, you should probably be getting up to 50. Just keep moving this grain. As we move through spring, I do think we're going to see some price pressure. Right now, that 250 bushel year on year corn over corn ground up in Iowa and Illinois, maybe not for you guys, but for most of the corn belt right now, if you're sitting down putting pencil to paper, beans pencil a lot better than corn. And so, I think that we will see some higher bean acres. And I do know a lot of that corn on corn grounds had some struggles the last couple of years between drought and pests. Maybe these guys that are 90-10 on their rotation might drop that to 80-20. So I think we're going to have plenty of bean acres. The corn bean ratio is heavily in favor of beans. And the other crop that for the corn belt doesn't come into play, but we do grow a fair amount of beans down through the Delta region, even southeast part of the country, where cotton is a real alternative. Problem is with cotton's inputs, you really need cotton to be up almost to $100, and right now we're down in the low 80s, 83, 84 right now. So cotton's definitely not going to be pulling any acres away from beans at today's prices. So it's not just the corn that needs to come up relative to beans, it's cotton as well. And so I think we're going to have plenty of bean acres, probably see some downside pressure on beans as we're setting crop insurance prices. So what's that tell us to do with new crop beans? Well, much like the old crop and like the corn, I think sales sooner rather than later are going to be advantageous. Keep watch out for spring pricing. We closed Friday at $13.93. I think we'll get a shot to sell some over 14 board. Are we going to get 15 like we have on the front end? Not without a lot of help. I mean, if we burn up this summer, yeah. I said weather's a wild card. That can change everything. South America's crop drops often fails, yes. But conditions as they are today continue, $15 on new crop beans is going to be tough without some outside help. So keep doing some marketing there. So just kind of some general thoughts. I mentioned earlier, our inputs are down from the peak last spring, actually down from where they were in the fall, at least for most people and most inputs. And that's both fertilizer and chemicals from what I've priced. But in fall and winter 21, you have a chance to lock in things at a pretty reasonable level before they got crazy. We still really haven't had that opportunity for 23, and we're getting to the time of year where most guys aren't going to hang around to wait for it anymore. So we're probably overall going to be looking at higher input prices for 23 than 22. 22 crop, really a guy should have made money. Even the areas where you didn't raise an outstanding crop, your crop insurance should have stepped in. We had nice levels of protection there. You have some great prices to sell some crop now. 22 crop as a whole should have made you money. 2023, we're going to have higher cost of production. Operating interest is going to be a huge factor here. A lot of you guys have gotten used to 3.5%, 4% operating interest, and some of you have it locked in, and we'll have another year before it gets crazy. But a lot of you are probably going to be looking down the barrel 7% operating interest. And I think at the next Fed meeting, there's still talk of tacking another 0.5% on the prime. So 7% versus 3%, it's going to be a fairly sizable number, especially with the size of the total operating budget this year. So that's going to be a big factor. It's unlikely we're going to get a big fall winter run up bailout like we have the last year or two. That's not a normal cyclical trend. We've been running a little bit counter cyclical. You can't bank on that happening consistently. Like I said, you should have made money on the 22 crop. 23 is going to be tighter. If any of y'all traded equipment, you know how crazy that market's been. Add in operating costs, input costs. It's going to be lean for 23. Now, like I said, if there's a major crop failure, either here or South America, something blows up on the geopolitical front, this could all change. So those are the wild cards. But as it sits today, you can't bank on those things happening. And 23 looks like it's going to be a leaner year. So I just threw out a couple ideas. If you're not ready to go out and sell futures or write contracts because we're don't even have it in the ground yet, I understand that. So just kind of something you could do today to get a little bit of protection on for something in the new crop corn. I pulled this spread, just kind of some rough prices earlier. Corn was trading around $6, give or take a penny. You put on a spread, an option spread, 80 cents each direction. Buy, put, sell, call. It cost you 8-10 cents. But for that, you bought 80 cents of downside protection, and you've got open upside for another 80 cents. Whereas if you just sold a future, your upside's done. So as I kind of listed out the ways this can work, if it's above 680, you're capped out at 680. Below between 6 and 680, you get what the board has. Between 520 and 6, you get 6. Below 520, you're unprotected again, but you were able to capture that 80-cent window. For 8-10 cents, that's a pretty cheap way to give yourself 80 cents of protection and still leave 80 cents where this market can rally if we get some weather pressure. We can play with this strategy, higher, wider windows, narrower windows, cheaper, more expensive, higher strikes if we get a rally. It's very malleable. Just the kind of thing to start thinking about as a way to, get your toes wet on some 23 crop protection. Same exact thing on the beans, except instead of 80 cents, I went $1.20. Looking at roughly the same price, probably closer to 12 cents instead of 8 or 10. $1.20 windows. If you could spend 12 cents to give yourself $1.20 of downside protection, that's some pretty cheap insurance on soybeans. And you're leaving that upside open to 15-20. That's where the front end's trading. So you're not giving up a whole lot of opportunity cost here. It's a pretty desirable type of strategy. All right. And then I said I was going to do a brief little bit on the livestock. So hog numbers, like I said, we're down a little bit. Something to look at though is that cold storage is actually up quite a bit. And these two charts, the one on the left is total pork, the one on the right is pork bellies. The green chart, or the green bar going across there, is 2022. So for total pork, yeah, we're nowhere near where we were in 19, but we're still way above where we were the last 2 years, despite lower hog numbers. Similar story on the bellies. We're basically in line with where we were in 19, well above 20 and 21. So even though hog numbers are down a bit, we've got a lot of pork in the freezer. Not likely to run through that anytime soon. We've had a 2-week sell-off from the peak here. The front end really got roughed up. We're talking like those April hogs. They lost a lot there. You go out to fall winter hogs, barely affected. Talking a couple bucks. So if you still pretty close to the peak, if you're looking to protect some fall winter hogs, even some summer hogs weren't roughed up terribly. The ones here on the front end, if you didn't have those protected or sold already, probably not going to have enough time to catch a big rally back up to the peak there for those to do a lot for you. But hopefully we can see a little more action on them. I do think chart-wise, it looks like we've carved out a bit of a short-term low, maybe a buying opportunity to re-own something you've priced or dip your toes in the water there. But the biggest thing to look for on these hogs is, particularly these summer months, if we do get back up within spitting distance of these recent highs, you should probably look to get some protection on, and if you're in that market. Okay, cattle. Like I said, we're down 2% year over year again, but similar story to the hogs. The cold storage on beef is up there. You can see, a month ago we were above any of the last 3 years. Chart hasn't come out quite enough to see if we're going to maintain that, but we've been staying well above where we've been in the past. A lot of beef in the freezer, so even though cattle numbers are tight, got a lot of them in the freezer. Going to be a pretty good buffer to this market running up too much. And just like the hogs, we had a sell-off over the last couple of weeks. Again, concentrated on the front end. Actually think decent fed cattle were putting in new highs until a day or two ago. So they didn't get roughed up so bad there as you move further out. Feeders followed a similar pattern, sold off heavily on the front end the last couple of weeks. The thing to look at there, your cattle crush, buying feeders, buying corn, selling fats. For you feedlot guys right now, even with today's prices, you should be able to go out, buy your cattle if you get them bought right, and protect a small profit with today's board prices across all three there. You guys that are in this business know that a lot of the time that is not possible. And I'm not talking about, every operation's a little different and how you get them bought's a little different, but we're not talking 15, 20, 100, but $5, $8, $10 100 profits should be achievable, depending on how you get things bought here. And with the amount of money we're tying up here, expensive feeders, expensive corn, expensive operating money, that's a lot of money sitting out there in the lots. Probably going to want to be protecting some of that and be fairly cautious on these cattle here. You got a lot of money out there to not protect it. So if you have any more questions, you can bring them up here and Josh will let me know. Or you can call into the office, speak to myself or one of the other brokers. So I'll give you a few minutes if you have anything you want to ask me. And if not, we'll call it a day. And thank you for listening.
I'll give you guys a couple minutes or a minute or so to see if you have any questions, to type them in the Q&A. Dave, something you didn't really touch on that's been big is what are you thinking about land prices? That's something that's affecting everybody with rents and owning land, and just kind of what are your thoughts on that?
Yeah, well, obviously that's been a very wild market here the last several years, but particularly last year things got pretty out of hand. Down my neck of the woods, we're seeing some land values climb, depending on the type of ground, 30-40% year over year. Now, that's just not sustainable. And traditionally, you would look at interest rates coming up as a great way to tamp down that, the fire on that land market. Big difference we have between now and the 80s, the last time land took this crazy of a run, is that back then, all the land was pretty much being financed, mostly by, farmers, owner operators. That's not necessarily the case this year. Now, I don't have the percentages in front of me, but, we're seeing a lot of this land is guys who are paying cash and renting it out. Those cash guys, the interest rates going up is not really the problem to them that it is somebody trying to finance 80% of the farm. And so I don't think we're set up to see the bottom fall out of it like we did in the 80s. That said, two of the big reasons why land ran up, one of them is that there was nowhere else to go with the money that looked very good. Especially the last couple of years, the stock market's been wild and returns haven't been great. A lot, S&P was down. You couldn't get any money on CDs until recently. There just were not a lot of good places to go for someone who was sitting on a big pile of cash, and land was a safe investment with, consistent upside returns and annual revenue, dividends basically. So, hopefully interest rates climb, we get CDs paying again, we get some of these other markets coming to life again. You would say that maybe some of that money that's sitting here looking for a home can gravitate that direction, and I think a part of it will. But the other thing we got it's kind of come back to bite us, and we don't hear about it too much because we were the ones that pushed for it, is the stepped up basis. It's such a great tool to keep farms, family farms in the family from one generation to the next, and avoid that estate tax hit that, could really hamstring a guy 30 years ago. But that's also very appealing to somebody, sitting on, the doctor, the banker, the businessman from town who's sitting on a wad of cash, can go out and use that, and it works just as well for them as a generational transfer of wealth as it does for us. And some of these other places you can go with your money, you just do not have that advantage. So I think we'll probably see the market cool off a little bit. We're not going to see a 30% year over year rise again, but I really doubt we see it fall too far either. I think, we probably, if we saw a 2 or 3% drop, I'd say it would probably be the most we could expect on average, and more than likely we'll see it hold steady.
We saw that meteoric rise in it, but we really haven't seen that rise in rent costs. Do we think that's gonna eventually, I think it will catch up a little bit, but what do you think?
I do think it's coming. Everybody sees the market prices today on corn and beans, and you know how it is. Everybody wants a piece. First it's your seed man, then your chemical guy, then your fertilizer guy, and then the landlord. And, everybody gets their piece, and they're all going to want a bigger one because they've seen high prices the last couple of years, and the land guys have been paying that much more for land, or for the guys who've owned it a long time, been hearing about their neighbor getting that much more for his ground. And we're seeing, we're seeing guys that, not everywhere, but we're seeing some of these rents are climbing at a pretty precipitous rate. I know the old rule of thumb, and it's not doable on all ground, but they wanted 2% annual return for their cash rent on what they paid for the place. When you run up 30% in a year, that's not necessarily going to be feasible. But yeah, I do think that even as I talked about 23 being a year of tightening for profitability, we're probably going to continue to see the landlord want a little bigger piece of that. Now there again, as all these costs catch up with the sales prices and operating costs climb up, maybe we'll see the competition amongst farmers back off. Nobody offering, outbidding on the neighbor's ground with that high price cash rent. Because at the end of the day, the cash rent market is just what people are willing to pay. But yeah, I think we are going to continue to see a climb until we either set back market prices substantially or see a setback in land prices.
All right. Well, thank you for all of your insight today. We really appreciate that. And everyone, if you want it, I'll be sending out this recording of this webinar so that you can share it with your friends, your colleagues, anybody you think might be interested in it, or if you just want to watch it over again and kind of catch up on some points you may have missed. So we all thank you for joining us, and have a great rest of your day. Thank you, David.